Did you know that 80% of day traders lose money within the first year? You'd have better odds at a Vegas roulette table. Quite a jaw-dropping statistic, isn't it? Picture this. 8 out of 10 novice day traders are waving their hard-earned bucks goodbye within their first year. It's like a high-stakes game of musical chairs, but the music stops way too soon for most. This little factoid is not meant to scare you away from the world of investing. Rather, it's a cautionary tale to underscore the importance of understanding the game before you step onto the field. And that's precisely what we're here for today. We're about to delve into the common pitfalls that snag beginner investors, turning promising ventures into costly gambles. We'll cover everything from trying to time the market to the dangers of letting emotions rule your decisions. So if you want to avoid joining the 80% club, stick around as we reveal the 7 deadly sins of investing. The first mistake is trying to time the market, which is like trying to catch a falling knife. Now, for those of you who've never attempted knife juggling, let me be clear. It's not a recommended hobby. Market timing is the investment world's equivalent. It's the idea that you can jump in and out of the market. Buying low and selling high sounds simple, right? Just like catching a knife. But here's the catch. Pun intended. The market is unpredictable. Even seasoned investors find it difficult to consistently predict market highs and lows. So, for novice investors, it's like trying to catch that falling knife while blindfolded. The result? More often than not, it's a cut to your investment returns. The key takeaway? Don't try to outsmart the market. Instead, focus on a long-term, consistent investment strategy, because ultimately, time in the market beats timing the market. Our second mistake is ignoring diversification, or as I like to call it, putting all your eggs in one basket. It's like going to an all-you-can-eat buffet and only eating macaroni. Sure, macaroni is great, but wouldn't you want to sample the sushi, the roast beef, or the chocolate fountain too? Just like a balanced diet, a diversified portfolio can help reduce your risk. Think of it this way. If one investment performs poorly, it's less likely to drag down your entire portfolio if it's just one of many different investments. When you diversify, you're essentially spreading your risk across a wider range of investments, and this could potentially increase your chances of success. So my friends, don't be the person who only eats macaroni at the buffet. Try a little bit of everything. So spread those eggs around, folks, and remember, variety is the spice of life and also the portfolio. Mistake number 3, chasing past performance. Ever heard of the saying, past performance is not an indicator of future results? It's not just a disclaimer they slap on financial products to cover their backsides, it's a fundamental truth of investing. Just because a stock has been a high flyer in the past, doesn't mean it will continue to soar in the future. It's like expecting a thunderstorm because yesterday was rainy. The weather, like the stock market, doesn't work like that. Making investment decisions based on past performance is like driving using only your rearview mirror. Sure, you'll see where you've been, but you won't have a clue about what's coming. Research, analysis, understanding market trends. These are your compass and map in the investment journey. They help you anticipate what's ahead, not just reflect on what's behind. So, don't get stuck in the past. The future is where your focus should be. Mistake number 4, letting emotions rule. Investing should be about logic, not emotions. Now, we all know that's easier said than done. When it comes to money, it's like we're all on a roller coaster, right? One moment we're on cloud 9, the next, we're down in the dumps. But here's the thing, the stock market doesn't care about your feelings. It's cold, it's ruthless, and it's not going to give you a hug when things get tough. So, don't let your emotions dictate your investment decisions. You see, emotional investing is like going grocery shopping when you're hungry. You end up with a cart full of junk food and a big hole in your wallet. The same goes for investing. When you let your emotions take the wheel, you're more likely to make impulsive decisions that can lead to poor outcomes. So remember, in the investment world, keep your head cool and your strategy hot. You'll thank yourself later. Mistake number 5, neglecting to rebalance, or in other words, forgetting to do a little spring cleaning now and then. Now let's demystify what this rebalancing business is all about. Imagine your portfolio as a garden, with each type of investment as a different kind of plant. Some plants grow faster than others, and before you know it, your garden is overrun with one type of plant, leaving little space for the others. Rebalancing is like pruning back the overgrown plants to let the others breathe. In investment terms, it's adjusting your portfolio back to your desired asset allocation. Why is this important, you may ask? Well, over time, some investments may perform better than others, and your portfolio may become riskier or more conservative than you'd like. Regular rebalancing helps maintain your desired risk level and keeps your portfolio healthy. So, remember folks, a little maintenance goes a long way. Mistake number 6, overcomplicating investments. Remember, simplicity is key. Now, we all love a good puzzle, but turning your investment strategy into a Rubik's Cube is not the way to go. Overcomplicating things can lead to confusion, making it harder for you to make informed decisions. It's like trying to read a book while juggling flaming torches. It's not just difficult, it's downright dangerous. When investing, you don't need to be a Wall Street whiz or have a PhD in economics. All you need is a solid understanding of your financial goals, a basic grasp of investment principles, and the discipline to stick to your plan. It's not about having the most elaborate strategy or the most diversified portfolio. It's about making smart, informed decisions that align with your financial goals. So forget about solving the Da Vinci Code of investments. Keep it simple, smarty. Yes, smarty, because you're smart enough to avoid these mistakes. And finally, mistake number 7, failing to plan. As the saying goes, fail to plan, plan to fail. Now, I'm not saying you need to have a crystal ball or be the next Nostradamus. What I'm talking about is having a clear, well-thought-out investment plan. This is your roadmap, your blueprint, your best friend in the wild world of investing. Consider your financial goals. Are you saving for a dream vacation, a comfortable retirement, or your kid's college fund? Whatever your goals may be, your investment plan should be tailored to meet them. Don't just wing it. Investing without a plan is like driving without a GPS. You might get there eventually, but you'll probably take a few wrong turns along the way, so keep it simple. Set clear, realistic goals. Diversify your investments, regularly review and adjust your plan as necessary. And most importantly, stick to it. So remember to plan your work, and then work your plan. So, there you have it, the 7 deadly sins of investing. Let's take a quick trip down memory lane, shall we? First off, we learned that investing is not a gamble. It's all about making educated decisions, not just throwing your hard-earned money at the market and hoping for the best. It's not a game of chance, but a game of skill. Then we dove into the pitfall of trying to time the market. Remember, it's not about when to invest, but how long you invest that truly matters. The stock market isn't a crystal ball, so don't try to predict its future. Consistency is key here. Thirdly, we touched on the importance of diversification. Don't put all your eggs in one basket, spread them out. A balanced portfolio is your best bet against market volatility. Our 4th sin was the mistake of chasing past performance. Just because a stock did well in the past doesn't mean it will in the future. It's important to look forward, not backward. Next, we addressed the danger of letting emotions rule your investment decisions. Fear and greed can lead to poor choices. Stay rational, stay focused, and stick to your plan. We then tackled the issue of neglecting to rebalance. Remember, maintaining a balanced portfolio is a dynamic process. It's not a set-and-forget kind of deal. Regular checkups are vital. Our final sin was overcomplicating investments. Keep it simple, folks. You don't need a finance degree to be a successful investor. Just get the basics right, and you'll be well on your way. So there you have it. 7 common pitfalls and how to avoid them. But remember, this is just the tip of the iceberg. There's a whole world of investing knowledge out there waiting for you to discover. Remember, knowledge is power. So subscribe to our channel for more investing tips and tricks. Until next time, invest wisely.